How's everybody doing? Alright, so I got some great news. I got my wife's computer right here, and I'm going to share some great information for you that I found this week. So this has to do with, let's not say this has to do with, this is if you're trying to replace your income. And let's say your income's $50,000 a year. That don't sound too bad. And let's say if you're married, then between the two of you, it's $100,000 a year. Well, replacing $100,000 a year, that's going to take a while. But the good news, I got some good news. The good news is you do not have to replace that entire income to keep living the lifestyle that you've become accustomed to. The reason being is passive income is not taxed the same way that earned income is. And there's a couple examples here. I'm going to read this to you. This is straight off the IRS.gov website. It says, the 0.09% additional Medicare tax applies to individuals' wages, compensation, and self-employed income over certain thresholds. All right, now here's the part that applies to you if you're doing what I'm doing. It does not apply to income items included in the net investment income. So, from passive income, you're not paying Medicare tax. Medicare tax might not seem like that much, but it adds up paycheck after paycheck after paycheck. And you figure if you're working a job for 40 years, I mean, what in the world? You know, I mean, it's insane. I hate taxes. God, I hate taxes. But it's just something to think about. You know, you don't have to pay that Medicare tax, so it's a little bit less that you have to replace. I'm gonna go right here, and I do not like laptops. I like desktops. Go ahead and throw that out there. So I'm gonna change this. Look up. All right. So this one's for Social Security. Earned income generally. Now this is not off the IRS website, but you know, you can believe everything you read on the internet. I read that on the internet. Abraham Lincoln said it. All right, so earned income generally includes wages, salaries, and tips, and self-employment income. So-called passive income is not subject to Social Security tax. So that's two taxes right there that you don't have to pay on your passive income. You don't have to pay Medicare tax. You don't have to pay Social Security tax. Both of these are scams, and they are stealing from you to begin with. They shouldn't have any right to take your money anyway. I mean, it's not like you're going to get it back. If you do, it's going to be in pennies, and, you know, I could go on for hours about how much I hate the government and, you know, their thievery, but I ain't going to do that. So, you know, let's say you was making 100, well, I'm gonna use closer to my numbers. Let's say 93,000 is I think it's about where we're at. 40, 23, yeah, around 93, 95, whatever. So anyway, what I did is I took my last pay stub, I added the Medicare and the Social Security together, and I get paid every other week. I multiplied the number that I added together times 26. That's 26 paychecks, and wrote that down. And then I took my wife's, and she gets paid on the 1st and 15th, so she gets paid bi-monthly. So I took her Social Security and Medicare and added those together, multiplied them times 24 to get what she pays in a year, and then I added both those together. And it come up to being like $6,500, I think was what it was, something like that. So let's say we were making $96,500 a year. Now I only have to replace 90 to get the same income. Let me see if I can find anything on just regular tax on passive income and see if I can get any information on that. tax rates, long-term capital gains. We're not doing capital gains. We're buy and hold real estate investors. So let's see. If you go to, all right, if you buy a house, you rent it out for 150 years or whatever. Now, you rent it out for 10 years, say, and then you sell the house, and the house is worth more than what you originally paid for it. So there's a profit margin there. They tax that as capital gains. Same thing with stocks. If you buy a stock and the stock price increases, the difference between what you bought it for and what you sold it for, you get a capital gains tax. So yeah, they try to take money from you around every corner. Assets held for more than 1 year are taxed at 3 rates. All right, so it looks like let me make sure I'm reading this right. It says, this still has to do with capital gains. This is not really passive income. Let me go to something different and see what we can figure out. How is passive income taxed in 2020? It's outlined by the IRS. Materials participation is defined as involvement, activity, regular. Business is standard for participation, up to 100 hours of participation. How is passive income taxed? There are different types of passive income, from capital gains and dividends to incomes and earned on interest. Is passive income taxable? The short answer is yes. Tax rates on each type of passive income will vary based on how long your investments are held, the amount of profit earned, and or net income to understand how passive income is taxed. Let's go over capital gains. I don't care about capital gains. These 2018 tax code individual businesses. 3 big advantages. New tax plan, lower deduction, corporate, 2018 tax law benefit. Let's see here. Let's see what this says. No, I ain't gonna click on that. We're not that interested in it. Short-term, as mentioned previously, short-term gains apply to assets held for a year or less. So there's a short-term capital gains tax, and I guess there's a long-term. The short-term is something you hold less than a year, and I guess long-term is held longer than that. I'm not really sure. I've never really, like I say, I'm not into capital gains. Long-term passive income tax rates. I think we're on to something here. All right, long-term capital gains, assets held more than a year, are taxed at 3 rates, 0, 15, 20% based on your income example. No, this is not passive income. This is more capital gains. Well, they did say interest, so it may be about the same thing. For a person filing single earning less than $39,375 would owe 0% on any long-term capital gains. If an individual single filer makes between that, $39,375, so $39,376 and $434,550 in a yearly income, and chooses to sell a long-term investment or asset, a 15% tax rate would be applied to any profits earned. So that's going back into that capital gains. You got to pay an extra 15. Married or filing jointly while earning below $78,750 in yearly income is not taxed on capital gains on investments. Clearly, there is huge advantages to buying and holding investments long-term rather than short-term. So that's something there. How is passive real estate income taxed? All right, so I'm guessing this is our rentals right here. Lower tax phase. Buy and hold real estate. The qualified business income deduction is now 20% deduction on taxable income. This 20% deduction now allows investors to deduct a portion of their real estate investment properties, which could result in a higher ROI. when did this become a law? Well, whatever. Next, let's go over 4 ways real estate investors. All right, now we're going to go over 4 ways that real estate investors can benefit from the new tax cuts. Pass-through deduction. To qualify for a 20% deduction, the new 1998, with a new 20% deduction on pass-through income, LLCs, sole proprietors, and S corporations can now pass taxes onto the owner. Real estate investors with secured investments in LLCs will enjoy significant savings with this new pass-through rule. Not really sure if I understand that pass-through rule. 20% deduction on taxable income. To qualify for the 20% deduction on taxable income, a single individual must make less than $157,500 per year when filing jointly. I sound like I'm just reading it, just jamming stuff together on. Let's see. Or when filing jointly / married, income must be below $315,000 a year. There are ways to keep your income below a certain amount and qualify for these major tax cuts, including contributing to your retirement accounts, transferring income through to a C corporation, or donate to a charity. Well, I'm not trying to donate any money. I mean, it's a good thing to do, but I mean, right now, I'm trying to build a business and help the community out with housing situation. Shouldn't that be a charity? All right, so 100% bonus depreciation. If something depreciates in less than 20 years, this expense can be completely written off in the first year. For instance, the cost of a small home improvement project on your investment can be deducted from your yearly taxes. Well, I've explained that before. If your sink breaks and you fix it, keep the receipt. You can write it off, 100% of it. I don't know if it's still the same thing, but it used to be there was a breaking point. Let's say if anything under $4,500, you could write it all off at first year, and if it was over 45, and I'm not going to say that's the real number, but it was just something like that. Once you get anything here down, write that off first year. Anything here up, you depreciate that over 23 and a half years or something like that. It gets depreciated. Your tax guy will know what you're talking about. And then here it goes on to talk about the 1031 exchange. If you don't know what the 1031 exchange is, it's I'm not 100% sure how this thing works, but the gist of it is, you buy a house, and let's say the house is worth $45. You got it at a discounted price. You bought it at $45. It's worth $60. Keep it for 2 or 3 years. The value increases whatever percentage a year. Let's say it ends up being worth $65 when you sell it, and you get $65 for it. And like, the houses in this area have went crazy lately. Like, it's not really making me nervous, because I'm expecting a little housing market crash next year, and maybe the prices will kind of steady back off where they're supposed to be. But anyway, you made some money off of this, and you don't want to pay capital gains. You can use a 1031 exchange. You take that extra, let's say you bought it for $45, you sold it for $65, you made $20,000 profit. That's not including, the principal pay down in the meantime. But let's just say you made $20,000 and you went to sell it. You're going to have to pay whatever percentage. That's capital gains tax. You're going to pay capital gains on that 20 grand. That ain't cool. That's your money. Y'all not have to do that. So you do the 1031 exchange. You go and you find your house that's $65,000. It's in a nicer neighborhood. It rents for a little bit more. You don't have to pay capital gains, because it's like you just move the money from you move the money from one property over to another to increase your cash flow. And the way I understand it, and I may be wrong about this, but I'm thinking you never see that money. It's like you take your 20 grand, but you never see it. A lawyer holds that 20,000 for you in the meantime, while you're looking for another house or waiting on closing or whatever, but you never see it. It never goes into your bank account. Somebody else has to hold that money. I think that's the way it works. Don't hold me to that. Like I said, I've never done it, but that's kind of the gist of it. Let's see. All right, so this right here is doesn't really have a whole lot of tax implications, but this is very important. Very, very important. You absolutely must do this, and that's smash that like button for the YouTube algorithm. Yeah, that's all I'm seeing on this page about it, and I mean that's a lot of talking right there. Anyway, I'll be talking to y'all pretty soon. Please subscribe, share to your friends. Like I say, hit the like button, comment. I really enjoy talking to people. So anyway, I hope to hear from you, and you'll be hearing from me pretty soon.